Hello and welcome to our first investment strategy update of 2024. The global economy is clearly on path to normalization. Modest growth, falling inflation, and the prospect of interest rate cut isn't a recipe for a boom, but the slowdown looks manageable with no sign of a recession around the corner. The good news is that as the year gets going, a soft landing still looks on track in developed economies. In the US and Eurozone, activity in rate-sensitive sectors is no longer deteriorating, and we see no sign of major stress. Job markets are better balanced, with wage growth at levels that should get us in line with central banks' inflation targets. And so, disinflation is paving the way for the first rate cut by the Federal Reserve and the European Central Bank in spring. For investors, both rates endpoint and timing are key. But the outlook is not without risks. Geopolitics add a loud note of caution. The Israel-Hamas conflict, Red Sea tensions, and war in Ukraine each contain the potential to escalate with global consequences, but that's not our working hypothesis. For now, there is no sign of a second wave of inflation in oil prices or shipping costs, although these measures need careful watching. 2024 is also a year of key elections, notably in the UK, Eurozone, and crucially, the US. How the next US administration shapes fiscal, economic, and foreign policies will matter greatly for investors worldwide. Meanwhile, we expect China to focus on domestic economic challenges this year, including slowing growth, deflation, and property market pressures. So, what does it all mean for our investment strategy? Even with monetary easing ahead, an environment of higher interest rates than pre-pandemic has raised expected returns for fixed income and rate-sensitive assets. We have revised our strategic asset allocation to reflect the fact that now portfolios may need less risk to achieve their investment goals. This also simplifies our approach. We focus on core holdings with a tilt towards US assets and quality across asset classes. Besides, our new total wealth approach takes advantage of opportunities in traditional liquid assets as well as private assets for eligible investors. Tactically now, we keep a prudent investment strategy. Markets are facing challenging conditions amid slowing growth, potential market over-optimism on rate cuts, and geopolitical risks. However, short-term volatility could offer opportunities for adding risk. In equities, we keep exposures at strategic levels. Globally, investor sentiment is bullish and valuations are more demanding, but we do see stock market gains this year driven by improving margins and earnings growth. We have raised US equities. US stocks market's leadership and valuation premium can continue given macroeconomic and sector advantages. In fixed income, we focus on government bonds, US treasuries in particular, investment-grade credit, where we have recently also taken profits, and the higher-rated segments of high yield. Here, default and refinancing risk look manageable in a soft landing environment. As market digest the final stage of disinflation, new opportunities to add exposure may arise. In currencies, the US dollar should regain some support from US growth and yield advantages. We also like the Swiss franc, but expect some near-term weakness after a stellar performance. Downside risk for sterling still remain. Many of the risks to this outlook come from geopolitical tensions. But so far, oil prices have remained relatively shielded thanks to robust supply, but there are other threats to markets, including US-China tensions, with political risk rising closer to November's US elections. Gold prices could rise to around $2,100 per ounce, supported by geopolitical risk, normalizing US real rates, and strong physical demand. While we remain mindful of the challenges ahead, our strategic asset allocation gives us a solid framework. A framework which will continue to reinforce with our house view and tactical decisions to benefit from the opportunities that will surely arise this year. Thank you so much for watching.